a big section of Q&A at the end. Um, so that's the format. If you go through the slides as we talk, you have some questions you want to ask, just save that. I'll be asking and opening up for questions about every 2 to 3 slides that we talk about. And we can have that discussion there, and then we'll do a final Q&A at the end. All right. Well, let's get this going. To those that are here and participating via Zoom or LinkedIn Live, we appreciate your attendance. To those that might be viewing this at a later date, we still appreciate you checking out our content. I hope that this is valuable for you. Today's webinar is a part of a webinar series that we're doing every 2 weeks, plus or minus. Sometimes we have to move dates around. But the goal here is to provide educational content and to provide value to those that are seeking to understand what it means to either be a real estate developer or invest with real estate developers. And we'll be talking about different points within this industry. There's a lot that we can talk about on any given day. Today's topic is how to buy land, create value, and sell for a profit. This is something that I've had a lot of experience in. I know that my face might look pretty youthful, and it is, but I've been fortunate enough to be involved in a lot of land acquisition deals, development deals. My career started off as a land flipper, meaning that most of the deals I would do were projects I would buy with the intent of selling the land at a markup. Now, as I like to do with every webinar that we do, just introduce myself. I'm not going to spend too much time on this, but I have developed over 600 multifamily units over the past 9 years. And as far as the land acquisition, I've purchased at least 38 development sites. Many of those I have sold for a profit. Some of them I kept to build for myself. But of those that I purchased with the intent of selling, uh, we've been able to do so profitably on every single one of those. So, yeah, a lot of experience in the topic we're about to discuss. Okay, to start off, why is land overlooked? Now, you
Hey,
see a
Paul.
lot of people investing in all sorts of different asset categories, especially in real estate. Most of it is going to be already built and already cash flowing.
Hey,
So,
Paul. Do you
yeah,
mind sharing your screen again on Zoom so we can see what you're
yeah.
sharing there?
I didn't realize it stopped sharing, so we'll add this back. Okay, can you see the slides here?
Perfect.
Perfect. All right. So yeah, normally when you talk about investment, you think of buying homes to rent, or owning an apartment complex, owning an industrial facility, strip center, whatever it may be. The popular strategy is to invest in cash flowing assets. Now, why is that important? Well, investors like income. It's a really easy metric to see whether or not you made a good decision. Um, so land obviously lacks that. There are some exceptions. There are some situations where land can provide income. You can do land leases. Uh, Sometimes I'll see, billboards on properties that pay rent for easements, farm leases, things like that. But for the most part, land tends to be a non-cash flowing asset. Um, Another reason is land tends to be pretty speculative. There's a lot of unknowns. If you buy a piece of land, it's not quite as easy to see who the potential buyer is. You could be forced to hold on to it for a lengthened period of time. It's unpredictable. And there's a lot more variables that are out of your control. So there's a lot of investors that are uncomfortable with that risk, primarily because they don't understand what it takes to create value and to effectively market their properties to the right people. The important thing with land to know is that these risks can be mitigated. Um, and especially The important thing when it comes to investing in land is to enter into it with a plan. Land tends to be not a good investment if you're entering it as a speculative investment. You just buy a piece of acreage somewhere, you don't know what's going to happen. You're buying it for an appreciation play over the years. You think that the value is going to increase. Sometimes that can work very well, but sometimes that doesn't work very well. You never quite know how an area might evolve over time. Um, but if you purchase a piece of land with a strategic plan, saying, I have this purpose for this land, I'm going to create this plan and create this value, then that tends to be a significantly better investment. Your risk is going to be reduced. You're going to be able to know who to market to, and you're going to be able to realize that value in a much shorter period of time than the standard purchase and hold and hope that time will appreciate your asset. So, what creates that value in land? Well, zoning is the primary driver of the valuation of land. This is what sets the ceiling for your value, essentially. Now, a good way to describe zoning is it's a piece of law that's written into the city or municipality where your property is that dictates what is allowed and what is not allowed to be built on that property. And even beyond just built, it also dictates what the property can be used for from an operational standpoint. So if you want to, for example, run or have livestock or park trucks on a piece of land, technically you have to have permits or zoning that allows you to do so, especially if it's being done uh, at a commercial level. So let's use this as an example. I might own two different parcels. Let's just say both are 10 acres. Both are on a busy highway, a little bit removed on the outskirts of a city. Well, uh, both properties might look the exact same. They're flat, have grass, um, no noticeable differences. But if the zoning map, an example here shown to the right of the screen, shows one property is zoned for R16, if you see these yellow zones here, which tends to mean residential, so a single family home, 1 unit per 6,000 square feet. So now that 10 acres, I can split that into 6,000 square foot lots and sell lots individually or build on those lots. So that's one of my properties. The other one might be zoned, let's use an example here, MU, which is mixed use. That's usually going to be the highest density zoning. That could build commercial, that could build residential, that could build high density apartments, office space, etc. Well, both of those properties, even though they look physically the same, from a law standpoint of what can be put there, they have significantly different potential of what can be built there, and therefore the value on that might be significantly different. We're talking about millions in valuation difference between those two properties. So zoning is significantly valuable. You'll see people all the time who make money by finding uh, acreage. So it might be an agricultural zone or very low density zone, and doing a zone change to create more density and hence create more value. That tends to be risky, but it's something that people do to create value. Now, let's talk about highest and best use because this is important when it comes to land. Highest and best use is essentially within the specific zoning of your property, what is the most valuable use that is allowed for your property in that zone? A good example for this, and I see this all the time, you might see a home on 10 acres, which is, if you look at it, a really nice home on a lot of land. Most people would dream to have that. But oftentimes, those types of homes are on land that's zoned at a much higher density. So that 10 acres might allow for 10 homes, or 100 homes if it's a multifamily, or it might allow for a commercial big box store like Walmart. All those things have different uses, but the owner is using it as a single family home. So in that scenario, if it was zoned for, let's just say commercial, where you could put a big strip center on it, is that piece of land at its highest and best use? Well, no, it's a home that's on 10 acres, but it can become something more. And so where we create value in land, and where the money is made in this strategy that we're discussing today, is in identifying and finding properties that are being underutilized. So if I can buy that home that's sitting on 10 acres that's zone commercial, and I can put a strip center on it, if I can buy that home for the price of a home on 10 acres, and I can convert the use to that strip center, which is the highest and best use in this scenario, then I can create significant value now to the next buyer of that land who wants to build the strip center. That's conceptually what we're talking about. Now, you might ask, why is land underutilized? If that person is sitting there with 10 acres of land, on a home on a piece of property that you could build something much more valuable, why don't they do it themselves? That's a good question. Sometimes property owners like their current use. They're more emotionally invested in the property as opposed to looking to make money. Maybe that's been passed down through generations of their family, or it's their dream home and they don't want to move. But more often than not, the answer is, if there's an underutilized property, the owner of the property is unaware of the zoning. They're unaware of the highest and best use. They're not savvy when it comes to real estate investing. They just own the property. They may have purchased it years ago or inherited it. Um, and having someone that understands this process and understands how to find and identify opportunities for value creation, that creates a lot of value where you can come in and approach that person and have an opportunity to buy a piece of property at a good price that's significantly underutilized and can be converted to the highest and best use. So I'm going to stop there for a brief second, um, and open this up for questions. So far we've talked about uh, the zoning, highest and best use, converting property to its highest value potential. And we've also talked about why many investors tend to shy away from investing in land. So, what questions do we have from the attendees so far? One moment here. So, as a reminder to those that are on LinkedIn Live, there's a lag in between LinkedIn Live and Zoom, and so if you're wanting to participate um, and not have a gap, if you want to ask questions, join the Zoom link that is in the description box and in the comments section. I'm being told I need to share the screen here um, for the LinkedIn Live. So just bear with us one second while we work out these technical difficulties. Okay, sorry about that, guys. Unfortunately, to share with LinkedIn Live, you have to go through a number of different systems, and you got to make sure they're all working together well. So we just had to sort that out. I'm going to share my screen again here on Zoom. All right, can we see that? Delvin, Mike?
No, hang on a second. Something, something went awry here.
I see zoning in HBU, so
Okay,
I
perfect.
think we're good.
Awesome. Okay, well, let's move on, and then if there are any questions that came from there, we can talk about it a little bit later. All right, so how do we find deals? This is where I tend to stray a little bit from the pack as far as developers go. Most developers they have commercial agent contacts that'll send them great opportunities. Most of them are primarily location centric. So developers want to find uh, property that's well located, and then they'll worry about zoning later. Usually, developers will try and buy a lot of land so that when they request a zone change, they can add other things that the city might want to as leverage to get that approved. But at the end of the day, they still get to build the project that they want. To me, that's always been a little counterintuitive. Zoning, especially doing a rezone, can be quite risky. It can be expensive. It can take a lot of time to be able to get that approved if you do get it approved. And so that's never been an approach that I've liked doing. So how do we do it instead? First off, I don't really use agents a lot. That's not to understate the value of a commercial agent. Some of them are good, some of them are bad, just like any industry and any professionals. But once a property is being shared by a commercial real estate agent, the odds are uh, most of the value is understood. So, a commercial agent, their job is to understand the uses, what a property can be used for, and so they're going to price that into the price that they're sending you. So, I like to find off-market opportunities. Now, I also don't look much at commercial sites such as LoopNet or Crexi, others, because commercial land and commercial deals tend to be marketed in a different place than your residential homes. If you ever bought a home, you'll know that oftentimes those homes are listed on what's called the MLS. Well, an exception here where I do use and look for listed properties that are represented by agents is I like to find commercial land deals that are listed on sites traditionally used for residential homes. And the reason I like to do this is the following. Let's examine a scenario here where you have someone who owns, let's just say, 20 acres of land in the city limits of a large city. Now that person has owned it for 30 years, passes away, and now they have, multiple children, let's just say four children that inherit this piece of land. Well, these children don't want to sit on the land. They want to sell and cash out and get the money. But they've never done real estate before. It's not their expertise. They know nothing about what's going on. Well, who do they turn to? Perhaps it's their cousin or their friend, whoever is a local realtor who sells homes that they know, oh, this person's a real estate person. I can trust them to sell my property. Now, they're not aware that selling land and selling homes are completely different things and require completely different expertise. And oftentimes, that friend or relative agent, um, they're also not aware of what they don't know, and they're happy to take this on. So they listed on the MLS where no commercial developers are looking for opportunities to buy. And so I find a lot of deals that meet to some degree that scenario that are sitting there on the MLS that no one's noticed is for sale for the past many months or even in some cases years. But this land is sitting there at a good price because it hasn't been researched by those that are trying to sell and list. They just give a price to what they want. Sometimes that price is above the actual value. Sometimes it's significantly below the actual value. So that's an example of where you can find value and find potential deals that other people are not looking for. In general, though, my approach starts with uh, a zoning first approach. So uh, as opposed to trying to find the best location and forcing the zoning, I'm going to go and research cities within an area that I want to invest. Let's say it's Texas or maybe the Dallas Fort Worth area as an example. There's a lot of different cities within the Dallas and Fort Worth market. Well, I'm going to do an in-depth research and go through the zoning ordinance of every one of those cities, and I'm going to identify which of those cities have multiple zones that permit what I want to do. So in my case, I'm a multifamily developer. I'm going to find cities that have zones that allow for multifamily land. And in particular, I'm looking for cities that have zones that you may not expect would allow for multifamily land. For example, everybody knows in this industry that a zone such as MF20 tends to mean multifamily 20 units per acre as the density. So everybody knows that I'm going to be pursuing the MF zoning in an area if I want to be a multifamily developer. Well, sometimes because zoning is very nuanced, you have zones that aren't intuitively um, a multifamily zone, but allow it within their list of allowed uses, such as oftentimes I find cities with commercial or industrial zoning, but it has multifamily as a permitted use. And so I like to identify cities within an area, find the ones that have those hidden zones that permit what I want, and that's where I'll focus my activities. Then once I find that city and that zone that I want, then I'll worry about the location within the available zones that I have that I'm pursuing. So I'll try and find the best vacant or underutilized properties, the best located vacant or underutilized properties within that city, within the zoning that I want. And then I'm going to begin either researching properties that are already for sale or contacting owners directly. And contacting owners directly tends to yield the best results. These are going to be people that haven't actively tried to sell their land either recently or ever. And some of them are going to have zero interest in doing so, but many of them will be interested. And so you find the people who are interested, and then you start to underwrite the deal and figure out what price you can offer. And you have to go through a lot of these to find one that works. But once you find one that works, it's a great deal. All right, so talking about how do we evaluate these projects once we find a good opportunity. So let's say you have a willing seller. Um, First off, not every deal is right. So you might have a willing seller, you might have a price that you feel like is fair, and terms on the contract that you like. Well, this rendering here on the left side of the screen is an example of a deal that I had all of those things, but it wasn't a good deal. This is one that I pursued, and luckily I ended up making money off of this. But uh, but it was more of me taking a fee for someone to take my position in the contract. But it's not a deal that I ever would have purchased myself because of the metrics. Now, why is that? Just because you have a property, for example, that's let's just say you have 2 acres and a property that allows you to build 100 units per acre. So these are going to be that type of density will often be a downtown location where you can go really high, do structured parking, etc. So in order to achieve that density, what do you have to do? Well, I just listed a couple of those. You have to do underground parking or podium parking, which is structured but it's above ground. And then you have to start building really high, multiple stories on top of that. Well, that changes the classification under building code. It requires more expensive materials, especially with the underground parking is very expensive, but it doesn't increase the income or the rents that you can charge for that complex. Sometimes they'll require a commercial on the bottom floor, which makes financing very difficult and increases the expenses as well, makes the insurance discussion very difficult. All these things can compound to say, well, maybe I can build a lot of units on this property and strictly from a per door purchase price, it looks pretty good. But the cost to build this outweighs the ability I have to make it happen. And it makes it so that these margins that I would expect normally get tighter and tighter until it just doesn't work anymore. So that's one example of many. Just because a deal works up front doesn't mean it's the best deal for you to do. Ideally, you want to find deals that require cheaper building styles. I tend to stay away from structured parking. I tend not to go above 3 to 4 stories. Beyond that, it starts to get very expensive. You want to avoid buildings such as building materials and requirements such as elevators, steel structures, etc. Now, there are companies out there that can do those things profitably, but they also know how to underwrite it very well. Unless you have that specified expertise, I would recommend staying away from those things. Okay, so let's talk about entitlement now. So now we've found a property at a good price. We've evaluated it. We know that we could build this profitably. Now, how do we really start creating value in this property? So entitlement is the process of taking a property with all the potentials within an existing zone. So it's taking a property with intention, sorry, potential, and it's narrowing the scope to say exactly what is going to happen and what is going to be built on the property. I like to explain this as by comparing it to our educational system. Let's just say you have a student that's getting ready to graduate high school. That student is going to go to college. And that student has endless possibilities of what they can do for a career path, right? They could be a doctor, they could be an engineer, they could drop out of school and enter the trades, which is also a great option these days. But the possibilities are endless. Now, as they enter college and start attending courses, they're going to declare a major. They're going to get education that's specified towards a specific topic. Now, while it narrows oftentimes the potential jobs that they're able to do. So if I take classes that are oriented towards business and entrepreneurship, for example, well, it's going to narrow their options if eventually they wanted to go and be a doctor, right? They'd have to go and redo school. However, it creates more value for them in the field that they've declared. So let's look at this from an entitlement perspective. How does that compare? Well, you start off with a property and it has a lot of different options that could be built within a certain zone. As you take it through the entitlement process, this is drawing up plans. This is submitting it to the city and getting approvals. Now this becomes a very narrow scope of what can be done, which limits the ability to go and do some of those other options unless you go and go back through school, if you will, and go back and redo this process. But it also creates a lot more value to the prospective buyer who wants to build, for example, an apartment community. Now they don't have to go through all that time to and expense to go through the entitlement process. So you've de-risked the deal for them, and developers will pay premiums for time savings and certainty of what they can build. So those are the two key elements here that you're creating with entitlement and how you are creating value with these properties. Now, how much value can you create? I've had deals where I've made north of $1 to $2 million per deal just in completing the entitlement process and selling it to a builder who wanted to pay a premium for that time savings and for that certainty of what they could do. Because oftentimes, especially in multifamily, it's very difficult to find quality multifamily deals. So if you can find the quality deal, quality location, and take out all that entitlement risk, you have a very valuable property. So I'm going to stop there for a second. Um, any more questions uh, that you'd like to review before we continue in this, whether it be on entitlement or how we find deals, how we evaluate deals, etc.
I have one question for you.
Yeah.
In regards to highest and best use and understanding zoning, if I were to go into a new county or city, what's the first place you'd look to get more information on zoning requirements?
Yeah. So the question essentially is, uh, like conceptually, you need to understand zoning, but what tools and resources do you find within a city, and how do you start to find what can be built, or zoning information? Is that your question?
Yeah.
Okay. Yeah, good question. So the first step is if you can't find, you look for it online, but if you can't find what you want, you always just pick up the phone and call the city. Usually the people that are in charge of zoning and code of what can be built in a certain area is going to be the city planner. So when I started learning how to do this, I would just call the city, ask to speak to a city planner, and say, "Hey, I'm looking for these zones, or I'm looking to know what zoning my property is in, or I'm looking at this property. Can you tell me a little bit about what the city's vision is there and what the zoning will allow?" Things like that. So having phone conversations is a great place to start. Every city will have links on their website for you to see the zoning maps and what's called the city code or city zoning ordinance. Now, the tricky part is they all tend to be a little bit different words. Some might say city code, some might say municipal code, zoning ordinance, etc. But it all kind of fits in about five or six different words that it could be. So once you do enough research, you tend to learn what that is and you can find it easier. But again, if you have a difficult time finding it, you just call, ask for a city planner. They can guide you through their website and where to find those resources. And then once you find the city code, then you look at, or this within the code, you'll want to find the zoning ordinance. Sometimes the zoning ordinance will have its own link in the city website. But once you're in the zoning ordinance, that's where you can find each individual zone. You can open that up, read more about it. And what you're looking for is typically a use matrix. So this will be a table that says all the different zones and then all the potential uses. And you'll have permitted, so usually P for permitted, and then other letters, depending on the city, it's different for what's not permitted in that site. So you can learn which of those zones allow for the desired use that you have. So good question. Any other questions at this point?
I have one.
Yeah.
So I have a piece of property in North Texas, 16-acre commercial property that is currently zoned industrial. We there it was a feed store. It's still a feed store actually now. But basically it's underutilized, I guess you could say. And Dennis looked at this project with me a couple of years ago and went and looked. And so we were talking about the zoning, and what is it zoned for? What's the highest and best use? Well, it's currently zoned as light industrial. And I've been in multifamily for about 20 years myself as a contractor, not as a contractor, but as a subcontractor working with developers and builders. And so we thought, well, maybe we could change this to multifamily, or mixed use.
Yeah.
And we discovered that that's, with the purpose being to create, to give the developer some certainty that if a multifamily developer wanted to, purchase this property, he would already, have an inroads with the city with the zoning being in place. How difficult is that to you know, perform, or is it worth the effort? Just leave it as light industrial. I mean, I've had other people say, well, just leave it as light industrial. That's probably the highest and best use anyway, as opposed to trying to change it or let the developer change it.
Yeah. So in short, your question is essentially how do you weigh whether or not to do a zone change and try and change the use to
Yeah,
something that you perceive as more valuable potentially,
right.
or should I just keep it as its own and try and market it for the highest and best use within existing zoning? Does that
Correct.
sum up your question pretty well?
Yes, yes,
Awesome. Well, as it happens, I've actually been to your property there. I think that's just north of McKinney, right?
correct.
Okay, yeah, I'm thinking of the right property. I know Dennis showed me that one time when I was out in Dallas, so
Right.
uh, I'm familiar with it. Here's what I would say to that. Zone changes can be risky. Sometimes that risk pays off, sometimes it doesn't. And so if you are comfortable, if you have, for example, a buyer or you feel like the value in that area is more valuable for a multifamily zone over light industrial, you could try and do a zone change. But the question is, what support are you going to get with the city and local leaders. Now,
Yeah.
sometimes this can be deceiving because you might have a city planner who might love the idea of a zone change there, right?
Right.
And they're going to get you excited and say, "Yeah, I think we can do that." I think, and then all of a sudden you go to planning commission and present at city council when it comes to the zone change. You might have neighbors show up and talk poorly about it. They don't want density there. They don't want apartments, and all of a sudden these opinions can change. And all you need is a couple no's, and then you're out all that time and money. So there's
I
the
see.
risk. The opposite can be true. Sometimes the city planner can tell you, "No, I don't like it," but maybe you get support with the council, and that can happen.
Right.
But I find that unless you have a piece of leverage with the city, in other words, you can give them something that they really want,
I
uh,
see.
more often than not, a zone change is going to be uh, not successful. And usually, when you're trying to change from industrial or commercial to multifamily, that's not going to that on average that will not garner as much support because most cities hold very closely their industrial and their commercial land
Okay.
because commercial and industrial is their biggest source of tax revenue for the city.
Right. Yeah.
And
Tax revenue.
so it doesn't really help them to put. Now you could say, well, they want affordable housing, and every city is going to tell you, yeah, affordable housing is a crisis, but none of them are really going to hold that as a big factor in their decision making when it comes to how they want to design their city, unfortunately. Uh,
Right. Okay.
so that's some of the things that I would be considering as you're evaluating that. The easiest path to creating value for your property and realizing profits is going to be to identify the current zoning and identify what the most valuable use is or future use is of that current zoning. And that's where you'll be able to expose that vision of value and be able to monetize that. That's
Okay.
that's usually what I would recommend. Not to say you can't do a zone change, but oftentimes you have a lot of hurdles to overcome with that, and there's a high risk to that. I don't know if
Okay.
that helps answer your question.
Yes. Yeah. That's helpful. Thank you.
Yeah. Cool. Well, we'll move on and we'll open it up for questions again here in a little bit. Okay, so we talked about the entitlement process. I think we have a basic understanding of how that creates value. This is one of the coolest things I think that we do, and one of the ways to really take advantage of this value entitlement starts from the very beginning when you negotiate the purchase contract with a potential seller of land. So, first off, price is important, but it is not everything, right? So, if I want to build 100 units on 5 acres, if the seller's asking for $20 million for that piece of land, well, that's a non-starter. So, price is important, but as long as you're within the realm of reasonability within price, that becomes now a secondary term, um, and one that, in my opinion, is not as important as time. Time for me is usually the single most important term that I negotiate in a deal. Why is that? Well, first off, it takes time to complete due diligence, and due diligence is the research up front and tests and studies and all that you do on a property before you actually complete a purchase and commit money to it. And so that reduces the risk of a deal. You know a lot more about the property. You've been able to vet out any potential geotechnical issues or environmental issues that might prohibit you from building or building to the same degree that you want to on a piece of property. So that's important. However, beyond just your normal due diligence, what it does is it creates value before you have to purchase. So, for example, city entitlement processes can be long and time consuming. Let's just say that on average, a city it takes if you're really on top of things, it takes between 6 to 10 months to take something all the way through the entitlement process. Well, if I can tie a property up before I buy it, have a contract that allows me to complete my due diligence, and then gives me time to take something all the way through the city entitlement process. Well, now I've been able to generate significant value before I have to close on the property. So this helps me in a number of different ways. One, if my goal is to sell the property for a profit, it allows me to create that value and market that value to potential buyers before I ever have to close on the property. And we'll talk about the marketing aspect here on the next slide. But the other component on this is if I'm trying to find investors, whether that be to buy the land and eventually flip it for a profit, or to continue with construction of that piece of land, well, it makes a difference because now the investors know that they're investing in an entitled piece of property. So that risk of what it can become and what it's going to be is completely eliminated. Uh, they know that they're investing in something with all the due diligence completed. So all these third-party reports and studies that could identify potential issues um, uh, are removed. So that de-risks the deal for them too. And then third, if you completed the entitlement process and created all this value, well, you're still purchasing it at the price that you negotiated from day one. So now you're purchasing a price at significantly lower value than the property is today through the value that you've generated. So as an investor, I'm coming in at a much lower basis, and I'm walking into day one equity to protect my investment. So it makes raising capital, especially for land takedowns, so much easier for you to do this. So contract negotiation is important. Time and price are just two examples of different terms you can negotiate. Virtually any term that you can think of that is lawful and that the buyer and seller both mutually agree to, you can include in a contract. There's a lot of different ways that you can or different terms that you can add in there that actually create value. I think that's for a different discussion, but contract negotiation is very important. And it's better to have that done on the outset as opposed to trying to renegotiate terms later as well. Okay, so let's talk about the marketing aspect and sales portion of this. As I mentioned, option one of the reason why it's important to create time in these contracts is it gives you time to market the potential value of a property. So the first thing that you want to do going into this, if your goal is to sell a property for a profit, is you want to build a list of potential buyers. When I was doing this early in my career, I called every builder I possibly could, developer, investor, fund, real estate fund, and I try to get as many of their contact emails and phone numbers as possible, so that anytime I got an opportunity, I could send it out to this. Commercial real estate agents is another one. Architects, engineers oftentimes have contacts that might be looking to acquire land sites. So build a list of potential buyers, earn a reputation in your local market for someone who provides quality opportunities. You don't want to just be a spammer, but someone who provides quality opportunities is valuable. And then step one after that is you expose the vision of a property. Now, here to the right, there's a picture of a property. This is in Cache Valley, Utah. And this is a deal that probably one of the most successful land flip deals I've ever done. But this will illustrate for you what can be done and what is possible when you're implementing the pieces that we've talked about today. So this is a property in northern Utah. We got it under contract, uh, and I'll use approximate numbers, but it'll be pretty close to what we actually did. We got this under contract for $1.4 million dollars. Now, from a zoning perspective, we knew that this property would allow for up to 160. Uh, Actually, I think it allowed for more, but 160 units is what we were able to achieve on density. So this property, as you see it right here, that was worth $1.4 million dollars per market. Well, we hired an engineer to draw up this concept plan. So this will show how you can build 160 units, how you can fit it with the parking and the setbacks. This zone also required some commercial, and so it'll show the little retail centers. And all we did was we exposed the vision by drawing up what could be done here. And now people are looking at it in a different light. We sent an email to our list of buyers, and within a couple of days, we got a response um, saying, "Hey, I'm interested." Now, after a couple weeks of sending that email, we had this property under contract both to purchase, but also to a potential buyer. They wrote us an offer. We accepted that offer. And the markup, I think their offer was at $3.3 million. So if you do the math there, you're just barely under $2 million from the 1.4 to 3.3. That nets us $1.9 million from a $1,000 concept plan that we invested. Now, normally with that type of markup, I would expect to take a property all the way through entitlement. Well, in this case, the buyer actually wanted to do their own plans and they wanted to do the entitlement process. And so they closed in 3 months for $3.3 million. All I had to do was draw this concept plan, and I had to provide a geotechnical study and a phase one environmental study, which in aggregate cost me $10,300. So the 1.4 million, 10,300. Uh, we closed on the property, so we purchased it and we set it up because we had that time negotiated in our contract. We were able to set this up for what's called a double close, which means I bought it for 1.4 million and I sold it for 3.3 million all in the same 24-hour window. So that is an example of what you can do with when you understand the value of entitlement. And in this case, all we had to do was expose the vision and help people see and realize what the potential of this property was. So that's pretty cool. Now, the last thing I'll say here with this strategy of selling land, buying land, selling it for a profit. All the time, I see sellers that want to hold on to every penny of value. I'll give an example. I built 214 units recently in Waco, Texas, uh, and there's a property that's not far down the road from that, similar zoning to what I just built. And the seller there is selling the property for a very reasonable price, and it's zoned for exactly what we want to do. And it's well located. But the seller expects a buyer to come in and purchase it within 3 months from putting it under contract. Well, as I told you in our last slide, time is the most important thing. So I'm not going to purchase something that forces me to purchase within 3 months. I want the time to take it through the entitlement and create that value. So we approached them about 2 years ago, gave them an offer. That offer was, I think, a 10 to 12 month close. They said, no, we want 3 months. And we said, no, we're going to pass on, move on to the next opportunity. Well, 2 years later, I check in with them about every year, and it's still for sale. They still haven't sold it. And they still won't sell it unless we can give them a 3 month timeline. So maybe one day I end up buying that property. I don't know. But that's an example of a seller who is holding on to an idea of what they want, and they're passing up opportunities. If they had just accepted, a 10 to 12 month close, that property would have been sold by now. So take the money when it comes. That is my biggest recommendation when you're trying to sell land. As long as you can make a profit. Live in abundance. There are a lot of deals out there. You can do a lot of deals. Don't hold on to every single one. What could you be doing with your money on one deal and flipping multiple deals as opposed to holding on for every last dollar? If if entitlement generates a 100% markup for your property and you get an offer at a 50% or 70% markup, take it. Do the next deal. So that's the one piece of advice I would give for anyone that has property that they're looking to sell, and who can take a property through this entitlement process, is allow the market to decide when you sell. When you get an offer and it's a qualified buyer, that's the one caveat to this. It needs to be someone who's qualified, and have reasonable confidence that they can take something down, move forward and do a deal. So that concludes today's webinar. I'll open this up for any last questions. Any more discussion points we want to have here? If there are no questions, then
Yeah,
then
it's
we
all
will.
good.
Sounds good. We will wrap things up today. So I appreciate
Hey, Paul.
yeah.
Hey, Mike here. Since it looks like you might have a few minutes, and again, I'd like to just, if I could, maybe call and talk to you about Core Flax, just kind of a latest update on that.
Sure. Yeah. Yeah, we can talk
We can
offline
do it
about
obviously
that.
not as part of the recording and not of the webinar and all that, but if you have some time, that'd be great.
Sounds great.
Cool.
Okay. So the last thing I want to talk about here is upcoming webinars. Like I said, we're doing this approximately every 2 weeks. Um, our next webinar here is going to be on February 24th. The topic of this is going to be market selection. So this is how to choose where to buy and invest, which cities, which markets are better than others. And then the following after that's going to be March 10th. That topic's going to be how development deals are funded and financed. So this is going to talk about how to raise capital with equity, how to secure debt, what those sources are looking for, all that good stuff. So we hope that you're able to participate with us in those future webinars. I hope that we've been able to provide value for you today. This is a topic that I really love. I think it's exciting to be able to buy and to sell land, to build on it. It's something that I'm passionate about. So I hope that you're able to take some of the pieces of information that we've shared and implement that in your own strategy and that's successful. So we'd love to hear about those successes if and when you have them. In the meantime, have a great day, and we'll see you on our next webinar.
Thanks,
Thank you,
Paul.
Well,
Paul.
thanks, Paul. This was super educational, super interesting. Thank you.
Thank you.